Lewis asks a question here related to iron condors. Here we go. There's the iron condor. Popular strategy. Many of you have heard me say that I haven't actually legged into or traded an iron condor in probably almost 3.5, getting close to 4 years now, just because of the market conditions. I'd rather play directional. I've been doing well with the bull puts. This year, as Sam mentioned, has been a little bit tricky on some of the bull puts. VIX calls took care of some of the bigger declines that happened when some of my bull puts got into trouble. Many of you might have seen the webinars we did at the beginning of this year in 2019 related to the credit spreads, where we showed that the proper bull put structure could even have been successful in 2018, even though 6 of the 12 months were negative market performance. That was here. Let me just go there real quick. Sorry. Option strategies, and I'm sorry, I went too far. All right. There we go. Credit spreads beyond the basics part 1. That's where we talked about the structure we like to look for in the bull put spread. But beyond the basics part 2, what we took a look at is, well, if the bull puts did well, but not as well as we expected in 2018, because 6 out of the 12 months were negative, wouldn't the bear calls have done better? And the answer was actually no. Just flipping the probability and the structure you look for in a bull put and doing that to 2018, bear calls were actually a loss. Because it wasn't that 6 months of 2018 were negative market performance because there was a gradual decline where you could keep selling bear call credit spreads. It was that in each month there was a 3 or 4 day period where you had that massive drop where you could be very successful in bear call credits. But 4 out of the remaining 6 months, the market was lower left to upper right, where you had almost a 95% success rate on bull puts, and you would have had, even with deep out of the money and a 90% probability, close to a 40 for 50% loss on the bear calls because of that movement. I believe it was April through June. No, not April through June. I'm sorry, June through September, May through September of 2018. And then, yes, you would have been successful in bear calls from October 5th through December 26th because the market was fluctuating, but it essentially went right down. You would have lost a little bit in November the first week. In any case, the reason why I bring that up is because during that same course period I was talking about was doing iron condors, what I looked for in general wouldn't have worked for me as well as the bull puts did. Why? Because on the times when I lost on bull puts, I still would have been losing on the iron condor. And on the times I lost on the bear call and was profiting on the bull puts, I would have been losing on the iron condor to the upside because I would have had to manage the bear call. Louise's question is much more simple than that. And it's not simple by any stretch of the imagination, Louise, but it's not related to this, is it a good strategy? What his question is related to is the search criteria. What Louis wants to know is, how is the algorithm set up on PowerOpt to search for iron condor? Is it on price symmetry or a dynamic where delta is a factor? Technically, it's both, but I'm not using delta at all. Ernie and I don't have delta. Oh, here's Joe's question here. We set up a search based on probabilities above, below, and between for the position. But let's go to just the basic, all right, let's go to weekly iron condor, see what comes up for next week. Shopify, Wynn Resorts, Tesla. Not when I'd probably do an iron condor. Just maybe they've been looking good recently, but always makes me nervous. Broadcom, Boeing right now. Ugh. In any case, the main options criteria you can see at any time. It's right here. Okay, so you can see here the criteria that are being used, the active criteria, and you'll see this on any search that you pull up, any strategy search you pull up. You'll see the active criteria for the options, technicals, fundamentals, and more. So this is our weekly search, so we've got the weekly expiration day set. Now, we are looking for basic return, a double leveraged credit spread, good 6 to 8% return minimum. You'll see mostly higher than that in the search results. Minimum net credit of 25 cents between the two spreads because, yeah, I want to make sure that I'm covering commissions even if I'm only trading with 3 or 4 contracts at this particular position. We want to be out of the money on both the call and the put side. Now, this percent out of the money range, this is the criteria that's using it related to part of your question, Louise, when you said price symmetry. And that's what this is, percent out of the money range. What the percent out of the money range means is, where is the stock price now? in relation to the two strike prices. Okay, so where is the underlying price currently trading in relation to the range between the short put and the short call? Meaning, a percent out of the money range 50 means the stock is trading exactly between, equidistant between your short put strike and your short call strike. I don't try to skew the iron condors. I don't try to come in every 10 days and readjust the default search for the iron condors and say, well, it looks like we're in a bearish market. Let's skew it towards the call side so we could get better premium up here. And if the market falls as we expect, we got a really good premium on the bear call, but went further out of the money on the bull put. Or it looks like we're in a bullish market. Let's skew it down to the put side. So we're only 2% out of the money on the puts, but we think the stock's going up. Let's make it 10% out of the money on the calls. We don't do that. Try to look for an equidistant iron condor with a good probability of staying between the two strike prices. Start at a minimum of 75%. I typically increase that to 80%. 80% probability that the stock would be trading between the two strike prices, and I may look for a minimum probability of 80% that it would stay above the short put strike price and the short call strike price. Okay, that narrows it down a little bit. Take out, we've got Win there now, Shopify, NVIDIA, Tesla, as you see, disappear. Oh, no, it's at the very bottom. My apologies. Tesla's there as well. So, per the search itself, the percent out of the money range is dictating price symmetry. I like it to be right in the middle. You know, it might be skewed a little bit, but we're trying to force it to be right around 50, in the 40 to 60 range. And the probability is the theoretical probability, of course, the stock will be trading between the two strike prices. Now, I'm not using delta in this particular search. You could use delta if you wanted to, but the idea between it here is if you're using probability, let's take a look here. The probability betweens we have on the 9 positions, 10 positions that remain is 80.1%. I see an 83.7. Okay, so that's our low and our high. So kind of restrictive probability between based on our other criteria for going 1 week out, certain range out of the money, certain probability between with a certain net credit. It's only 8 positions that match it. And of course, no skew. We're trying to look right in the middle as best as possible. Now, let's see if I have it here. I'm not sure if I do. So I'm going to go to Add Remove Columns very quickly here, customize this a little bit. When you hit Add or Remove Columns, it takes you here. And what do we want? Something I don't think I have here in the Iron Condor screen. I thought I did. Give me a second. I know this is a lot to look at, ladies and gentlemen. I've got my bid-ask spreads, short call out of the money range there, return, risk. Okay, I'm sorry, I don't have it here. We're going to take a look at it in just a minute. I have the delta ratios. I just wanted the short option delta. Okay. All right, so what I was going to show you, and I can almost guarantee this is true, with all the work I've tested, not testing, but all the work I've been doing for the bull put credit spread project that's coming out soon, I show specifically that a lot of criteria go hand in hand. And looking for criteria that match what I want to see here with this probability range, I can almost bet, I can almost guarantee that the short put strike price and the short call strike price, so 101 here, the short 117, the long on stock at 110, both of these deltas are going to be at around 0.12, 0.13, 0.14. Okay, I'm restricting it by delta because in order to have the probabilities, the deltas have to be in that similar range. So I'm not using delta, I'm using probability, which will also equate to delta as well. To answer your question directly, it's using both. I want a good price symmetry. I want it to be between the strike prices with a good good premium coming in and a good return, good range out of the money, even though we're only going 5 days out, with the probability that essentially equates to delta, Louise. Okay, and of course there's some other factors in there. I don't want anything that has earnings between now and expiration to be surprised in my position. So 110 or 9 down, 9 up. So that one's not close, but in any case, let's take a look at Win. Let's just take a look at big charts very quickly. I'm sorry, I didn't want big charts. I wanted to go to the profit and loss chart, Luis. I'm sorry. So what I want to see here, of course, we can see it that it's a little point, it's a point off exact middle, right? The stock was at 110. We're 9 points out of the money on the put and only 685 on the call. So it's within 40 to 60%. It's not smack dab in the middle. You could customize that search and say put it 45 to 55, 48 to 52 for the percent out of the money range to get it right between the two strike prices. That's essentially what we're looking for here with that search. It's related to the probability, as I mentioned, and it's related to the price symmetry, as you mentioned as well. We don't try to skew them to sort of be predicting a bullish or bearish market run by going further out of the money one direction or the other. Okay, all right. Okay. All right, so last thing here, of course, as I mentioned, we won't go through all of them, but let's just go ahead and go to the, now that I'm here, let me just go to the option chain for the call and the puts. I'm sorry. This just took me to the puts only. That's fine. We're going to sell the September 6th, right? That was our weekly search there. The September 6th 101 put was our sell option, and the delta is more than I thought, 0.06. Okay, so with that probability, now here we are, with the different probabilities here for 88% for the 103, 84%, you see it almost lines up to delta. They're subtly different, but similar factors are used in the same equation for delta and probability. So if you only want a 12 delta, you'd be looking for an 88% probability. If your service, your education says that you only want to open a certain vertical spread where the delta is less than 0.25, just use a probability of greater than 75, and that'll equate to the same thing. Okay. Fernando, I'm not sure when your question came in. Your comment, I should say, came in. Fernando says you've been having good luck with this strategy. I don't know if you're referring to the I'm sorry, I don't know if you're referring to the iron condors or if you're referring previously to the buying the long straddle question we were talking about. I think you're referring to iron condors there by the order that the questions came in. And that's good that it's been working out for you. I'm not saying that you can't be successful with iron condors, don't get me wrong. Just what I thought the market was doing the past 3 years, I was having better success personally. I'm not saying I have the best criteria, but the criteria I was using and that I was trading with the bull put credit spreads was more successful than what I was trying to apply with the iron condors that I looked for originally. Not what's set there at PowerOptions, but other criteria I was using for 2 to 3 week out iron condors, and I wasn't having a lot of success. These new headline-driven markets, it's very difficult to go more than 3 to 4 weeks out in time with an iron condor, I found, because there's just too much fluctuation over that time period. You really want to keep it shorter term. And with the standard vertical spreads, I really want to keep it shorter term as well.